Okay, so in the last video, we demonstrated using the HighLow method to break a mixed cost in between the variable piece and the fixed piece. And so we looked at data and we identified the high volume amount and the low volume amount. Okay? And then we used that to determine the variable cost per unit. We divided the difference between the cost at the high volume and the low volume point and divided that by the units, the difference between the units at the high volume point and the low volume point. And so then we were able to take that variable cost per unit and multiply it by the number of units at the high volume point, and then that told us what the variable cost portion was of the high volume cost. And the difference between the total cost at the high volume point and the variable cost portion would be the fixed portion. And then we could use that to develop a formula, right? And so in our example, the x-ray cost came to $3.95 per x-ray plus 85 cents in fixed costs, and we add that together to get our total cost. And so that was a pretty easy method, but the HighLow method only looked at 2 data points. If we use regression analysis, we will be looking at all of the data points and we will get a more accurate formula. So, if you're a math guru, you might do the regression analysis. You might do it by hand. I am not a math guru, so I use Excel to do my regression analysis. And so, if you use Excel, you'll get a report like this, and the important things to look at are R-square, which tells you the strength of the correlation between volume and costs. And so this one, it's 0.94, so that's a very strong correlation. Anything 0.8 or above indicates a strong correlation that you can rely on. And then under intercept, this will tell you the fixed cost piece. And then the X variable one, that would be the variable cost per unit. So we can see that our mixed cost formula would be $7.85 per unit plus $14,538 in fixed costs. So if you're going to use Excel to do your regression analysis, you go to Data on the menu bar, click Data Analysis. We highlight the cost data as the y-axis data range. We highlight the volume data as the excess data range, and then Excel will perform the regression analysis. So let's take a look at that. So if you're on the Data tab, you click on Data Analysis, and then we want to choose Regression and say OK. And so we want to choose the Y range, which is going to be the costs, and then the X range, which is going to be the volume. And then you say OK. What did I do wrong here? All right, so I had it in there twice. Now I say OK, and now I can get my report. And so we can see the R-square is 0.98, so that's a strong correlation. The intercept, 123 approximately, that's our fixed cost. $3.98 is our variable cost per unit. So we can see our x-ray cost using regression analysis is $3.98 per unit plus 123. So we can see we're more precise using regression analysis. So breaking our mixed costs down into their variable portion and their fixed portion is going to be really important for what we're going to look at now. What we're going to look at now is calculating operating income under absorption costing and variable costing. So absorption costing is what we learn in financial accounting. This is what you are required to use for GAAP right? And this will be for your external reporting. So under absorption costing, all of the product costs initially get recorded in the product. So direct material, direct labor, and both variable overhead and fixed overhead all get recorded as the product, right? And we looked at that, how the cost traced from the raw materials to the work in process to the finished goods. And so that stays on the balance sheet until the units are sold, and then the cost moves from finished goods to cost of goods sold. So here's our absorption costing income statement. This is the one that we've used. Sales revenue, number of units sold times the selling price. Cost of goods sold, number of units sold times the cost per unit to produce. Sales minus cost of goods sold gives you gross profit. Subtract our operating expenses, which are all of our period costs, and that gets you to operating income. And so the cost of goods sold, as I said, we need to get our manufacturing cost per unit. The variable costs are already stated as a set amount per unit. The fixed manufacturing cost, you're going to have to calculate. You take your total fixed manufacturing cost and divide that by the units produced. So that needs to get added to your variable cost per unit to get the total manufacturing cost per unit, and you multiply that by the units sold. Variable costing is where we are only going to be assigning the variable manufacturing cost to the product. The fixed manufacturing overhead is going to be treated as a period cost. And we are going to be preparing a contribution margin income statement. So this is going to look different than the absorption costing income statement that we used under GAAP. You can only use this variable costing, this contribution margin statement, for internal decision making. So this is what the contribution margin statement looks like. We start with our sales revenue. We subtract all of our variable expenses. Sales revenue minus variable expenses gives you contribution margin. Contribution margin minus fixed expenses then gives you operating income. And so we're going to get a different operating income when you use variable costing as opposed to absorption costing. And the difference is going to be for the fixed costs that are in the inventory units that you have produced but not sold. So when your inventories are increasing, so you have produced units that haven't been sold, right? So the units that you produced are more than the units sold. You're going to have a higher operating income under absorption costing, because those fixed manufacturing overhead costs for those units that you haven't sold, they aren't going to be subtracted the way they are on the variable costing statement. They're going to be sitting in your finished goods inventory on the balance sheet. So that's why you'll get a higher operating income under absorption costing when you produce more units than you sold. And so then if you build up your inventories, perhaps the next period you'll sell more units than you produced. And when that's the case, absorption costing will have a lower operating income than variable costing, because some of those fixed costs that were sitting in your inventory are now going to be subtracted this period. So there were fixed costs you incurred last period. They're being subtracted this period when the units are sold. So one of the reasons why the variable costing is going to be better for evaluating managers is if the manager's bonus is tied to operating income, it gives managers an incentive to build up inventory at the end of the period, because then they're going to have a higher operating income and then they'll get a higher bonus. But it's not good to incentivize managers to build up operating income, because we don't want to have our costs tied up in inventory. Let's take a look at an example. We have a company that sold 47,000 units. Selling price is $51 per unit. However, they manufactured 75,000 units. The variable manufacturing costs, so the direct materials, the direct labor, the variable overhead was $19 per unit. Fixed manufacturing costs were $325,000 in total. The variable marketing costs were $15 per unit. Fixed marketing costs were $33,000. Other fixed expenses were $20,000. And so we're going to do an income statement using absorption costing. So we know our starting point on any income statement is sales revenue. And our sales revenue here, we sold 47,000 units. And we're told the selling price was $51,000. So we have sales revenue of $2,397,000. After sales revenue, we show cost of goods sold. So we want to take the 47,000 units and multiply it by the manufacturing cost per unit. Well, we're told that the variable manufacturing costs were $19 per unit. Fixed manufacturing costs were $325,000 in total. So we need to determine what our fixed manufacturing costs were per unit. Well, we incurred that $325,000 in fixed manufacturing costs to make 75,000 units. So that means it costs $4.33 to make 1 unit. So in total, it costs $23.33 to make 1 unit. So we'll multiply the 47,000 times the $23.33. So there's our cost of goods sold. Sales revenue minus cost of goods sold gives you gross profit. And then we subtract our operating expenses to arrive at operating income. So our operating expenses, variable marketing costs were $15 per unit sold. So the 15 times, we sold 47,000 units. So 705 was the variable marketing costs. Whoops. We also had fixed marketing costs of $33,000 and other fixed operating expenses of $20,000. So $758 in total. Subtract gross profit minus operating expenses. Our operating income is $542,333 under absorption costing. Let's take a look at what our operating income is using variable costing. And so we're going to prepare a contribution margin statement. So our sales revenue is going to be the same, right? That's our starting point. But then we subtract variable costs from our sales revenue to get our contribution margin. So our variable costs, we were told that we had variable manufacturing costs of 19 and variable marketing costs of 15. So 19 plus 15 gives us our total variable costs per unit. And so we'll multiply the variable cost per unit times the 47,000 units that were sold. Oh, I'm on the wrong line here. So the 34 variable cost per unit times the 47,000 units sold is $1,598,000 in variable costs. So we subtract sales revenue minus variable costs. We call that contribution margin. Then we're going to subtract fixed costs to arrive at operating income. So for fixed costs, we had $325,000 fixed manufacturing costs, fixed marketing costs of $33,000, fixed operating expenses of $20,000. So when we add together those three categories of fixed costs, we get our total fixed cost of $378,000. Contribution margin minus fixed costs gives us $421,000. And the difference between our operating income for absorption costing and our operating income under variable costing is the portion of the fixed costs attributable to the items still left in inventory. So the 75,000 units minus the 47,000 is the units sold. those fixed costs